Sir, the session is live now. You may please start the session.
Okay, no introduction by you.
Sir, if all the members know you already.
Eh, Any of my
Sir, we welcome you to the session, sir. Please start the session.
okay. So good afternoon to everybody. Today we are going to discuss one of the important topic that is related to the overview of Income Tax Act 2025. The first part we will discuss. Second part we will also discuss what is our role, what are the scope is available under the Income Tax Bill 2025, what is available, what is not available. And while I am going to give you the overview of Income Tax Bill 2025, I will also cover the, I will make a comparison with the old provisions and also few of the changes which are not made, but that can be discussed, have the importance in the Income Tax Bill 2025. And the background also we'll discuss first to have an understanding about the Income Tax Bill, evolution of the 1961 Act, and then subsequently what is the need of introduction of a new bill. And in between you might have very much aware about the DTC, Direct Tax Code, which was in between was compiled and was ready to be introduced but could not be introduced. So what are the changes has been proposed in the DTC and subsequently which was taken in the amendments? So all the facts will be taken into consideration during our discussion. Friends, before going for the detailed discussion about the Income Tax Bill 2025, let us have an overview of the background of introduction of Income Tax Act and collection of revenue through the income tax in India. Actually, prior to 1860, the taxes were levied and paid on traders, artisans at the rate of 20% of their income, and farmers paid a certain percentage of their production. So this was the basis of a collection of revenue during the British period prior to 1860. And British government, because that time the British government was ruling in India, the Income Tax Act was introduced in a different form to recover the losses from the 1857 revolt. You might have Sepoy withdraw, whatever was there at that time. There's a lot of loss of revenue and a lot of spending of the money by the British government. So they try to introduce certain kind of income tax act to collect the revenue. The significant reforms has been taken place in 1918 and 1922. Actually, the act of which was continued after the independence, 1947, was the Income Tax Act 1922. So few major changes has been taken place in the introduction of the 1922 Act, which continued up to 1961, and subsequently 1961 Act has come into effect in India. So 1961 Act, if you take into account, and 1962 rules. So Income Tax Act 1961 introduced during 1961, and subsequently the rule also framed in the 1962. The full-fledged Income Tax Act 1961 and 62 is continuing at present, and which is proposed to be transited to the new income tax bill from 1st July 2020, sorry, 1st April 2026. So 1961 Act, which was established the current framework, it have a 5 heads of income. Actually, as I remember, it was 6 heads of income, but subsequently it was merged and income from other sources. So it will become 5 heads of income: income from salary, your income from house property or the house property income, income profits and gains from business or profession, your capital gain, and income from other sources. So in addition to that, we have also certain framework of computation of income on which tax is payable. The provisions include the clubbing of income. The provision includes the set off and carry forward of losses. And the provision also provides how to compute the taxable income. Certain deductions can be taken, certain exemption can be taken. So it is now become the 75 years of old. If we count to from the let to take a 40 and 25 years particular, sorry, years, and amendment made 65, actually 65 years old, amendment made in the 65 times. Every year the finance bill was introduced, and the changes has been incorporated by way of the act, and the act became very voluminous. And during 65 years, more than 4,000 amendments has been taken place. So the bill, the act which was introduced in 1961, over the years it became very voluminous. And major reforms government taken, particularly in 1974, 1985, and 1997. So reducing the tax rates, simplifying the tax slabs. We'll a little bit discuss also what are the highest tax slab was available in India. But with the reform process, you will find the tax base was very low. Tax base means the amount on which the income tax is calculated, or any tax is calculated, that is known as a tax base. It was leakage of tax, leakage of taxable income or non-determination taxable income was a very higher side. So government could not in a position to collect the taxes. Government tried to make a lot of changes in the 74, 1985 and 1997, and but they wanted to increase the tax base and introduce different schemes, try to make a simplification of slabs, but still then it become it contains a lot of demerits, for which the expected result could not be received by the government. Then government thought that to make a major change, actually not like in the present context, the changes, they wanted the major change. That's why direct tax code bill was introduced. 2009 to 2014, we can say number of exercise has been made, debate has been made. The new bill, it was a new bill actually. The new bill was framed, drafted, also debated, finalized, but could not be placed before the both houses of parliament because of the change of the government, Congress-led government changed to the BJP-led government. So thereby it could not be possible. But what happens if we see whatever major changes has been taken place, whatever major changes has been taken place, it was also just sir, namaskar. Sir, hi, the one webinar I am there. Is it? Can I talk after 1.5 hours? Yes, yes, I'm sending. I'm sending. Yes, yes, yes. Sir, my email ID are you collected? You can. Okay, 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 definitely. I was chairman of the direct tax committee. Friends, let us continue. The direct tax code could not be introduced as a bill in 2020. The new tax regime introduced. So what happens? Whatever the setup has been made in the direct tax code, most of the provisions, actually the new provisions, what was the government intent to introduce in the direct tax code bill, or that direct tax code. So to my understanding, it was also subsequently from 2014 onwards, most of the cases that has been taken care in the finance bill, which was introduced subsequently from 2014, and amendments also taken place accordingly. And thereby, anyhow, many of the new changes has been incorporated. Many changes also tested that we will discuss. Particularly, I'm talking about the reassessment, source procedure, and where the major changes has been taken place to capture the undisclosed incomes. So that has been taken place. And 2020, new tax regime was introduced. So new tax regime, which was introduced in 2020, initially could not be accepted by many of the taxpayers. But subsequently, I will give a detailed statistics. Thereby, you will find the number of changes, new tax regime, whatever was introduced, the taxpayers has increased subsequently. Just a simple statistics I will give you. As per the last return filed, more than 75% of the total taxpayers are already opted in the new tax regime. 2023, 24, I'm 24, 25, maybe more than that. So that is there. And if you go to the history of income tax, many of the direct taxes were introduced, and many of them also abolished. Gift and wealth tax that was introduced to government. One thing, remember, whatever tax has been collected, to collect the tax, the expenditure has to be incurred. Actually, net tax is available to the government. So government always tried, any government is coming, they always tried that the net revenue should be more. So the cost of collection should be less. So that's why the government take a initiative for the introduction of many of the schemes, particularly the faceless schemes, and introduction of expanding the scope of advance tax and TDS and TCS. So thereby the maximum collection of tax made where no effort has been made by the government. So government only try to ensure the compliances. So gift tax, though abolished, but it was introduced in a different form, that the recipient of the gift will be liable to pay the tax under income from other sources. And the wealth tax was introduced, abolished. The reason is because of a low tax collection. So rather the tax cost of collection would be more than the tax collection, and many of the cases the wealth could not be captured. So that's why they thought that government thought that by introduction of different tables in the income tax return, so that's why the wealth can be captured. You might have seen, if you have a 50 lakhs more than income, the assets liability you have to also give in your return. So thereby government can have the access to the one's wealth. So that's why the wealth tax was also introduced earlier. Now it is captured by way of a return of the income. Interest tax was abolished. It was introduced, abolished. Companies profit and surplus tax. It was a direct tax. It was introduced and abolished. Tonnage tax. Anyhow, there is an amendment has been made. The tonnage tax, particularly shipping companies, they are required to pay the tonnage tax. Angle tax, actually, particularly non-resident Indians, those who are investing money in the certain category of investments where the value of security is less and the market value is more, through that extent certain taxation was introduced. And equalization levy was introduced and abolished. Sorry, equalization levy is continuing. MAT and AMT and MAT credit. This concept was introduced in different form. 1997, the book profit tax was introduced. Many of the companies, because of deduction exemptions, were not paying the tax, because you know that the depreciation is one of the area where the substantial benefit is given in the initial period of the addition of the assets or manufacturing functioning operation of the manufacturing unit. So huge depreciation is there. There is a depreciation loss also there, which is carried forward. So what happens? You might have seen many of the companies in India, particularly 1997, when the book profit tax was introduced. Prior to that, they are having the huge book profits. Dividend is declared in the AGM, but while computing the taxable income, because of the depreciation and other similar type of tax benefits which were allowed to the industry, thereby the taxable income become nil. Rather, there is a loss, and loss to be carried forward to set up in the future years. So government thought that in that case, a book profit tax should be introduced, and the company will make the payment of book profit tax or the taxable income, normal tax on taxable income, whichever is higher. So if in normal tax is lower, then the book practice tax will be paid and the differential will be taken as a MAT credit. So a number of changes has been taken place. So my point of presenting before you that before going for the detailed discussion in 2025 bill, at least we can discuss also the changes which is incorporated and what is the at present 1961 Act, so that we can go for the detailed discussion. So dividend distribution tax 1997 it was introduced, abolished the 2020-21, and in different form the computation provisions has been introduced. Presumptive tax plays very important role. Government thought that you see what happens in many of the cases, particularly I'm talking about the assessee, those who are engaged in the business and profession category of assessee. So there are generally they are required to compute their income as per the provisions of Income Tax Act. So profit of the profit and loss account will be taken. Expenditure from the business profit and loss account to, as per the provisions of Income Tax Act will be taken as a deduction. The balance or difference has to be taken and as a taxable income. But sometimes what happens, it's very difficult on part of the government to ensure that whatever expenditure has been taken as allowable expenditure or taken as expenditure in computing of business income is genuine or not. It's not practical, not possible in all cases. So thereby what happens, the government has given an option. So instead of going for the computation as per the provisions, a certain percentage of the receipt can be treated as your income on which you can pay the tax. No further deduction will be allowed. So that's why government tried to expand the scope of presumptive tax. We will also discuss in comparison to the present provisions in the Income Tax Bill 2025. But still, you remember that many of the provisions has been incorporated to give access to the assessee to accept it and take the certain percentage of its receipt as the income without taking any deduction and pay the tax. Security transaction tax and fringe benefit tax was very short period it was introduced. Subsequently, it was also abolished. So that means if you see these are the taxes, those were in the red color. These taxes introduced and continuing. Those who are in the blue color, they are introduced and also abolished because of many reasons. And India also witnessed one of the very important point when the government is so prompted to have the new introduction of new bill. One of the reasons that you see, India also witnessed the sky height limit tax rate 97.75%. Friends, you might have seen old regime 30% is the highest rate. New regime also 30% is the highest rate. And if you go to the corporate sector, and there is also certain percentage of rate cut also started. Actually, as I remember, in 2013 or 14, the previous government committed, and subsequently also new government, so continuing government also, they committed that they will reduce the corporate tax. Actually, if you see the big four or big five firms internationally, they make a different tax study, and they made also rate tax rate study also. If you see the tax rate in other countries, including OECD countries, you will find the number of countries are there, those in which cases the tax rate is very less than India also. Even if India has taken a lot of steps to reduce the tax rates. And if you see the history, 11 tax slabs was there, and 97.75% was the last slab of the taxation. And that has been reduced to 30% with the 3 slabs. So that means this 3 slabs is continuing for a long period. I think when I was, as I remember, when I joined in my service, mostly that time we are enjoying the, sorry, we are losing. That means the threshold limit and the tax rates are mostly 65%, 65%. Then it come down to the 55, 60%, then come down to 50 and 55%. Then it has come down to the 30% subsequently. I remember 35% perhaps as the slab never come down. particularly in individual and HUF cases, as I remember. But my point of taking here is government tried to reduce the tax rates, 11 slabs to 3 slabs. 97.75 is the highest slab, to highest slab is the 30%. And then the new tax regime was introduced. And in 2019, 1920, we can say 2021 assessment year, the highest rate of undisclosed income also still in effect is 78.5%. You might have seen the number of sections are there. Particularly, I'm talking about 68, 69, 69A, B, C. Like this, few sections are there where the undisclosed cascaded to undisclosed, cascaded to undisclosed income in by way of investments, wealth. Like this, is certain sections are available, and where the income, if not disclosed, and during the assessment it become the knowledge of the assessing officer, then the highest tax rate you have to pay. The undisclosed income tax rate is 60%. Still, it is continuing at present also 60% plus such as 25% plus health and education says 4%. But you remember, your surcharge is applicable where the tax is exceeding certain limit, 50 lakhs to take. But in this case, when there is an undisclosed income, irrespective of undisclosed income, the surcharge is 28%. So if your undisclosed income is 5 lakhs, the surcharge is 25%, still is applicable. So 60% into 28% of the 60% plus 4%, it will come effective rate will come 78.5% around, and that income is continuing. Reduce rate of presumptive tax, and particularly the composition scheme that has been introduced to encourage the people to opt for the presumptive, pay the taxes at least. And the rate reduction in case of long-term capital gain also made with a different method of computation. You might have seen in case of transfer of a property, land and building, etc., when the long-term capital gain is there. Earlier, it was taxable at a rate of 20%, but the indexation benefit was available. The cost of acquisition on 1st April 2001 has been taken, and generally the market price has been taken, and accordingly indexation was allowed. Previously, it was 1980 was the index base period. But subsequently, the government in 2023, as I remember, the amendment has been taken place, no indexation benefit, but your tax rate has been reduced to 12.5%. No doubt about it. In this process, government will get more revenue. You have to pay a little bit more tax. At present, if your consideration is more than 800% of the amount on which you acquisition made, roughly I was calculating in one occasion. So that is the reforms has been taken place in tax rates. Similarly, the new tax regime which we are talking about to introduce in 2019, actually it was not introduced in 2019, it was introduced long back, particularly in corporate sector. And you will find the new, as our government already committed that corporate tax has to be reduced, but government could not reduce it because there is a loss of revenue to the government. So government has given alternatives. So alternatives has been given by way of introduction of a new provision 115 BA, 115 BAA, 115 BAB, 115 BSC. BSC is the new tax regime for individuals, but the three sections, particularly 115 BA, 115 BAA, 115 BAB, the three sections which was introduced in the new tax regime started from 1917, 18, 2020, 21, that right side slide you can see, and the tax rate was 25%, 20%, 15%. But again, I'm talking 25%, 22%, 15%, the three types of tax rate cut which is made with certain conditions. And that condition mostly that certain benefits you have to forgo, and the details you can see subsequently also. But there is a if you want to avail 50 to 15%, then you have to also lose some of the benefits. So that's why you have to make an exercise to see which method is beneficial. You pay 30%, take all benefits, or you pay 15% without taking any benefits, and the carry forward of losses, MAT credit, depreciation, etc. That of applicable the individual provisions that you can go through it. So with this background, then we can go for further discussion. What are the status actually at present? If you see, as per the last CBDT data, 2023-24, 74.67% grocery, 74.67 crores of taxpayers are the PAN holders. So that means they are not paying tax, but they have the permanent account number. Once you have a permanent account number, that means you are identified. So actually, the very important point is, particularly in India, the tax base has to increase. Actually, the new tax bill 2025 is introduced with one of the objective that there should be an increase in the tax base. If the tax base is increased, even if the tax rate is reduced, but still then more revenue will be collected. And a number of taxpayers are 10.41%. Actually, taxpayers are 10.41%, but the return filed is 8.09, and 8.61 is including a revised and updated return. You might have seen Income Tax Act introduced a updated return 139.8A, whereby the if you have income but you have not filed the returns earlier, you have the income but you could not file the return earlier, and subsequently your due date is over and you are liable to pay more tax. You want to voluntarily declaration, so you can go for the adoption of the updated return and file the updated return. So we will discuss to some extent in the appropriate stage. So that's why updated return, the 8.61 minus 8.09 crores of return which was filed on a particular date of 2023-24, as I remember, up to January 20, sorry, December 24 perhaps. So this was the updated figure. So by which revised return and updated returns are filed. The tax collection has also increased substantially. I will give a comparative picture. After some time, you can see. So actually, government proposed in 2025-26 42.70 lakhs crores. So that is both indirect and direct taxes. And the effective corporate tax is 23.24. Already, I have told you that the tax rate is 30%, 25%, 22%, 15%. Four category of tax rates are available for corporate sector, but the average effective tax rate is 23.24% in 2020 to 23. Subsequent data is not available, but more or less it is around 22 to 23 to 24%. The tax collection last year it was more, actually 38.53 crores, and in previous year it was 34.66 lakhs crores. These are lakhs, 38.53 is the lakhs crores. And distribution of income, already you know that whatever government is collecting the income tax, including corporate tax, indirect tax, including indirect tax mostly consists of your central excise, customs, and GST. So that has been also distributed to the states. So government mostly this particular government has increased the distribution percentage, and day by year we found that more percentage of the total revenue collection by the central government is distributed. And 2024-25, they have distributed 12.87 lakhs crores to the different states and union territories. And 25-26, they are keeping 14.22%. So that's why whatever revenue has been collected by the central government is also distributed to the state governments, and balance they are spending for their meeting the different plan and plan expenditure. Okay. So the tax area, if we see the tax collection, no doubt government is introduced new bills, etc. But tax collections are increased. But at the same time, government could not collect the revenue from the because of the disputes, and if you take the tax dispute amount is 15.39 lakhs crores. and it was not in dispute, but government could not collect is 15.71 lakhs crores. That means 1 year's revenue government could not in a position to roughly nearer to that. If revenue is 42 lakhs crores, around 31 lakhs crores government could not in a position to recover at present also. And whatever revenue they are getting not only distributed, but some of the revenue is also forgone by the government because of different exemptions and deductions. Actually, different exemptions are available. You might have seen day by day because of the introduction of a new tax regime, that will take a 72 to 75 types of exemptions are not available if you are opting for the new tax regime. But the same time, government also under the Customs Act, under the trade policy, accordingly also under the Income Tax Act, certain amount they have forgone. That means not collected because of that. And the statistics which published in the budget, around 99,000 crores in the corporate sector, 12,271 crores with the association of person, business of individual, body of individual and firms, and 2,22,989 lakhs crores is the, sorry, 2,20,989 crores individual HUF exemptions are available. So if you suppose no exemption will be there, then around 3.2, I think 3.25, sorry, 3.32 lakhs, 3.32 lakhs crores are available for the government. So government day by day wanted to reduce the exemption, and the new tax regime actually, even if introduced, certain deduction exemptions has been going to be forgone, but government decided to reduce the tax rates so that people will opt for the new tax rates. And you might have seen that's why they have also not discontinued the old tax regime in the new tax bill 2025. So both options are available. So, but still, then we can keep in mind that government may, after the introduction of a 2025 bill from 2026, you will find many of the exemptions also further can be taken away. And the effective corporate tax rate is 23.26% for the last year. 10.75 lakhs companies, actually those who are paying the taxes. 9.19 is the non-manufacturing. So service sector contribution is more actually. And only 1.56 lakhs is of manufacturing companies. So manufacturing tax rate is less. So non-manufacturing is more. And before going for the discussion on the bill, just to see direct and indirect tax collection, which is 2023-24 updated, is just to see. And if you go to the 2001, and if you go to the 2023-24, there's a sharp increase in the all the taxes. Corporate tax, you see 35,000 some crores to 9.11 lakhs crores. Similarly, personal tax means income tax is 31,000 crores to 10.55 lakhs crores. Similarly, your indirect taxation 1.19 lakhs crores to it is 14.95 lakhs crores. This was figure 2023-24. But one point I wanted to tell you that you see the percentage of direct tax to the indirect tax. So the percentage of direct tax 36% to indirect tax is 57%. So that means there is a more growth on the direct tax collection than the indirect tax collection. But again, I'm talking 2 points on this account. If you see the present finance bill which was presented during the last few years, including this year 2025, and a subsequent new act also, you will find government wanted to increase the tax base. That's why the digitization, particularly in indirect taxation, has been made, and it is very well accepted by the taxpayers, and it was working perfectly, except appeal areas. Appeal areas is not working properly. Commission of Appeal having a huge pending of the appeals are there. Otherwise, all other cases you will find. So the point of talking here is you will find government wanted that to reduce the tax rates in income tax and corporate tax, thereby the exemptions and deductions which has been withdrawn, to that extent the purchasing power is available with the RCC or the taxpayers, and taxpayers can spend it for the purpose of a purchase of commodities or availing services. So thereby indirect tax also increases. So that means I am reluctant to pay the direct tax, but I will not reluctant to pay the indirect tax. The reason is if I have a surplus purchasing power, definitely to some extent I will spend for the purpose of purchasing certain commodity, availing certain services on which government indirectly also collect the tax. So that's why government has very strategically, to my personal view, is going forward, reducing the tax rates in direct taxation, encouraging people to disclose their income, pay the taxes, even if low taxes there, exemptions, etc. has been withdrawn. But I am inclined to go for the new tax regime because of my low tax. But to that extent, my purchasing power is increased, which I can utilize for the indirect tax. So that's why you will find even if the direct tax here is more, but the way the way it is moving forward, and the government keeping a target to collect more indirect tax than the direct tax, but at the same time government wanted, by because of digitization, because of different methods in the complying, ensuring the compliances from the taxpayers, capturing the data of the taxpayers, going for issuing of the notices if the taxpayer is not disclosing the income, not paying the taxes. So definitely the people are inclined to go for filing the compliance to the returns and pay the more taxes. So the main issue is thrust is on the payment of the taxes and collection of the revenue at a higher side. I'm just giving the one of the case what is the target has up to the updated collection has been made up to March. Actually, this is a figure I have given March. If we compare it, you will find the gross collection has increased 16.15% in comparison to the financial 2023-24. 16.14% is a very higher side. And at the same time, you see, you might have seen government also wanted that the more refunds should flow. If today I am filing the return, within 1 day it is also return is processed. As I was just going through one of the statistics in 2023-24, around 75% of the returns are processed within a week in the last week of the filing of the return, and the refund is absorbed. You see what is the refund amount? 32.51% comparison to last year. It was whatever refund has been made. So more refund government wanted to do it if you have a legitimate return particularly. And at the same time, advance tax collection also increased by 15%, around 14.62%. So this is the statistics generally we have, which we found it is there. Then if you go to the direct tax collection, just to see, and the cost of collection also reduced because it was 1% in 2001. Now it has come down to 0.44 because of a digitization. Now maximum tax is collected through the self-assessment tax and TDS and TCS, and compliance, by ensuring the compliance, very little tax is collected, and thereby the cost of collection is also very less. And this is the proposal, 42.70 lakhs crores they are keeping in the 2025-26. The details just you can have a look and see how the government is increasing. And very important is 2024-25. It was, if we compare 34.65 lakhs crores in 2023-24, it was a proposed 38.40, but it was also revised to 38.53. And the government also expecting more revenue than 38.53 for the last year. And this is the budget reforms, budget proposal which was made in 2025. Your income tax contribute 22%, your union excise is 5%, your GST is 18%, your corporation tax is 17%, and the rest others are borrowing non-tax receipts, but custom is also 4%. So these are the tax collection, your revenue is coming, and accordingly revenue has been spent for the purpose. And another very important point is how you really came to know that actually whatever tax collection made, actually it is properly working. Actually, these things has been taken by the government for the introduction of the new bill 2025. And you know that the tax buoyancy, we just always discussing, and tax to GDP ratio. And in India, the tax to GDP ratio is very less. Actually, it is 6.67% in the 2023-24. Slightly, they are projecting 2024-25 6.7%. 11.66 or 11.77 is the tax GDP ratio, including indirect tax. But if you go to the OECD country, I think it is 18%, around 18%. And if you go to the worldwide, it's 33 or 36%. Roughly, I'm talking. So that means the reason is if the tax GDP ratio is more, so that means one can ensure that your tax revenue collection is proportionately increasing due to the economic development. India is developing very fast. So when the economy is developing at fast, the tax collection should also increase at fast. If the tax collection is not increasing at fast, then definitely you have to find that you are one of the suspect. You can suspect that there is a revenue leakage. So in India, if you see it is 2 times. If it is 1 to 1, then economy and your revenue collection and economic development part to part. But it should be more than that. So collection should be more than the economic development, what is going on. So that's why it is 2 times. 2 times in many countries it was a very at a higher side. And if we find 2020-21, it is negative. So that means the tax buoyancy has not been computed because of the reason is the GDP and tax growth rate were negative. So GDP tax rate particularly was negative. These are the PAN holders. You see what happens. The 73.15 crores PAN holder out of 74.67 on 31st March 2024. Now it is maybe more. So you will find the individual PAN holders are more. And these are the actually statistics. Your company is only 25.49 lakhs. Body of individual 1.62, associate person 24.35, trust particularly is very important to 12.31. So these are the cases, but individual is coming 23.15, 97.97% ACC or the PAN holders are the individuals and HUF. And these are the returns has been filed. So total 1.09 crores. It was a very high growth. And similarly, the number of income tax return filed, including revised return, it was 8.61 crores. Already I told you, including the revised return and revised return and updated return. So with this background, giving a broad view of the income tax starting from 860 to 2025, and this will be clearly make a comparison by you while I am discussing the new tax bill 2025. So already two things I clarified to you. The 2009 to 2014, so the number of attempt has been made, introduction of the direct tax code, then number of discussions, finalizations about to introduce but could not introduce. But subsequently, the government has took some of the initiatives, measures, which were in slowly by way of introducing the finance bill. So if you see or if you examine from 2014 to 2024, the many changes has been taken place. Many of the cases government could not succeed. Particularly, I'm talking about restructuring of the assessment, reassessment, and such assessment, and subsequently also amendment in the such assessment in the last year. So, but still, then number of changes has been taken place to capture the taxpayers' income and to block the leakage of the revenue. So that's why that has been introduced. So now question is, government thought that the income tax become very voluminous and it suffers a lot of disadvantages. The situation where it was enacted in 1961, that situation is no more available, no more in India. India has developed now become well developed. So now it is need to have a very comprehensive type of income tax act. A layman can read, but anyhow, in the end, I will tell that a new income tax bill still also voluminous to understand by the individual, by any of the assessee, but still then it a lot of changes has been taking place. So finance bill 2024, the finance minister, while presenting the budget, announced to undertake a comprehensive review, not a new bill, actually a comprehensive review of the Income Tax Act or Income Tax Law, and to introduce the bill in 2025. So they kept in mind that it should be straightforward. It should minimize the litigation. Again, litigation, I have some criticism on this. I will discuss. Streamlining structures and a removal of redundant provisions, integrated and concise, practical and transparent. Law adopt best practice with the core taxation. Actually, in the due course, we adopted a lot of best practice which is available in all over the world, and enhance digital oversight. That's very important, particularly AI introduction, the computerization, capturing the data, etc. Data has to be taken place. The tax authority has to access the taxpayers' electronics record. Mark the word. The amendment also contains to capture your electronics records, emails, social media accounts, and online banking, etc. during the investigation. So the main purpose, because people whatever income government wanted to get since not getting, so government is apprehending. That's why the provision contains in the bill is to meet these are the criteria. So now what happens? The bill was introduced. Particularly before the introduction, generally is they have set up a departmental committee to review the Income Tax Act and identify to bring the suggestions, and in the process of starting of the process of working of the departmental committee, 20,976 suggestions were received. And initially, the 100 officers were engaged, particularly for review and drafting of the new IT bill. And subsequently, government thought to increase it because of the time, and 150 officers were engaged. And the Finance Bill 2025, the Finance Minister announced the tabling of the new bill in the Parliament. Actually, in the budget day, it could not be tabled within a week, but instead of a week, it has gone to the 13 days. So 13th February, the new IT Bill 2000 was tabled in Lok Sabha, and the CBDT immediately has issued two FAQ. My parents, you can go through the FAQ where the lot of information they have given, and a comparison also made section wise. What are the new section? What is the old section? What is the new section? And the parliamentary select committee was formed. Mr. Bajent Pandra is chairing it with the other members, and those who are making review. And ITB 2025 is to be proceed to the parliament to brought in effect from 2026. So now with this, so the parliamentary committee already working it. They are also inviting different trade industry, etc. I think our ICMI is going to make a presentation on 16th also this month for presentation. So they are calling one by one, and also taking the suggestions. And a bill is passed by parliament, it becomes an act. So actually, the parliamentary committee, after taking into consideration the suggestions made, so whatever they will examine, reincorporate, modify the bill, and then the bill will be placed. But at the same time, the very important point is the bill, only bill will not work. Income tax rule has to be incorporated. So for a new income tax rule and forms that has been drafted also in the process. So that's why the government already invited the suggestions regarding the new rule and new forms. And at the same time, the very challenging, very important that whatever software is available at present, because if you go to the income tax india.gb.in or e-portal of the income tax, you will find a very nice softwares are working, and which may not be in the GST portal of the central government to that extent. Anyhow, central government GST portal is very junior, infancy, we can say, even if it's 7 years there. But but from 2006 onwards, when the TDS was introduced in the portal of the income taxes, they are struggling, and now it become to a very they succeeded in to a great extent. But the challenge now is the conversion of the existing to the new, and continue with the old, because the old provisions still is applicable up to 31st March 2026. So whatever past period has to be starting from the scrutiny, filing of return, assessment, reassessment, search, seizure, etc. All the provisions up to 2026 will also be made. So portal will be, to my understanding, will be dual portal, dual functioning. One is under the new act, under the old act, and that is the requirement. So now coming to the overview of the bill. So what is the changes has been taken place? Is there any major changes or new changes? And if changes, what are the changes chapter wise? So that we can discuss now. ITB 2025 actually it preserved the familiar 23 chapter structure, heads of income, substantive provisions, the assessment and appeal procedures. The Annual Finance Act will continue to set rates for a particular year. Actually, these preserves, you know that the rate will be only changed by the Finance Act. See, they are keeping also in the new, no measure. So the structure remains same. Income from salary, income from house property, profits gains from business profession, capital gain, other sources, clubbing, setup, they have not changed actually. The deduction also they are in the chapter 6A, whatever earlier was there, maybe in the new section, but that deduction is also available for the old regime. So structural changes they have not made. Head of an income they have not changed. Many of the substantive provisions they have not touched it. Same provision they are continuing. So that we'll discuss wherever possible. But what they did, they have reduced the wordings by around 50%. So actually, if you see the ITA Act, Income Tax Act 1961, ITA, I need to, that I use the short word ITA and ITB. So ITA is drafted approximately 5.12 lakhs to words. Now it has reduced to 2.60. Almost we can say 57 or 66% of the wordings has been reduced. So that means you are going how they reduced it. So that you can see it also. The sections are 819. Actually, it is not 819. These are effective sections. Actually, present ITA is 298 sections. 298. But you might have seen many of the subsections are there, sub clauses are there. So if you take into account this is sub clause or subsection, then you will find there is a 819 effective section. So they have been counted, and that has reduced to 536 section. So what are previously subsections? Many cases they made it a section, and many of the sections they merged, or many of sections they omitted also. 1200 provisions, 900 explanations has been removed. You might have seen in the Act, one provision, one sub provision, one sub clause, then one explanation. So now the explanation, 900 explanation they have removed, 1200 provisions they have removed. So they are not keeping it. And the assessment year and previous year, the concept earlier was there, now it became the tax year. So this was actually concept was continuing from the British period. Previous year is the financial year in which you are computing the in which income you are taking for payment of tax. Assessment is the next year to the financial year or the previous year in which your assessment taken place. But now that words will not be used or utilized, or is not to be finding in the ITB. So it is only the tax year. So tax year consists of 12 months starting from the 1st April ending with the 31st March. But again, I'm telling in certain cases, tax year may be less than the 12 months. So actually the year in which the business assessee will start income and that year the tax year will be less than that, less than the previous year. So that means instead of 12 months, it may be 7 months, 5 months, 6 months. If I started my business that to take in the month of November, then my tax year will be, first tax year will be less than 12 months. So the tax year concept. So sometimes also we found very confusing when we are using the previous year assessment year. New students, those are coming, always confused to previous year assessment year. So now it is a tax year. So there is no doubt about it. It's a good proposal, even if it's small amendments made. Right side one table that I'm giving, which is few cases I will also discuss. Income Tax Act 1961 having the 47 chapters. Now it is reduced to the 24 chapters. There is a reduction in the 23 chapters. Sections 119 effective section, 298 is the actual section. So it has come down to 676, 283 has been reduced. The tables are 18. So you might have seen many of the sections, they made it table. Suppose I'm talking about TDS. You will find the TDS provisions starting from 192 and TCS up to TCS I'm talking 206. You will find a number of subsections are there, and same thing also repeated. Non-deduction of tax, rate of tax. Now they made it very clear table. 3 tables they made. So by table has reduced presumptive tax. They made a table. So instead of individual section, they made the tables. So earlier it was 18 tables. Now it is 57 tables. So there is an increase in the table. The formula also they made. In many cases they adopted the formula. So Income Tax Act is having only 6 formula, but now it is 46 formula. Thereby 40 formula has been increased. IT Act 14 schedules, they made it 16 schedules. And the words already I told 5.12, it has come down to 5.59, 2.59. So there's a reduction of 2.53. Word exemption 30,000. Again, I'm telling, actually the word which they reduced, the major word they reduced in the few sections, TDS section, TCS section, they reduced to around 42,000 words. Exemption section they reduced to 43,500 words. And the NPO, particular non-profit organization, restructuring of the sections has been made, whereby there is a reduction of 20,400 sections. So that's why the provisions, the wordings have been reduced. And undisclosed income, virtual digital asset, cryptocurrency, and non-fungible tokens, etc., has been taken in the scope of undisclosed income. If anybody having the transaction not disclosing, then it become undisclosed. Undisclosed means you have to pay at a higher rate of 78.5% around. Consolidation, particularly the exemption which they made, you might have seen salary. The exemption is in the section 10. So mostly the section 10, 11, 12. So these sections they modified because number section 10 is having number of subsections. So that's why they have mostly restructured it with a tabular form instead of section form. Tabular form is more attractive also. You might have seen many of the sections. You will find notwithstanding anything contained in contained. Similarly, in accordance with as many as prescribed, and many sections reference to the section subclause dash. This section will continue. So one section is referring to other section. So these are cross references also reduced. So that's a the cross section cross references has been reduced. Notwithstanding content that has been also taken away. No such wordings you will find in accordance with the as may be prescribed. These are indirect, we can say. These are the not active voice. These are these are the negative. It is started. So that's why that has been amended. Long sentence is shorter sentence. Actually, we have examined that. We found very many cases the long sentences has been reduced to the short sentences. Streamlining enumerations of multiple items by moving them to distinct schedules. Already I told you. So the schedule was a very important the area where the reduction can be taken place. and the compliances burden on certain circumstances has been made in the tabular form. Remove all of the outdated sections. Many of the sections they have already removed, not required. So not to keep it. All the substantive policy already I told you. The changes proposed in the recent finance bill also incorporated in the new bill. As already told you, because separately again they cannot include whatever proposal was there in the finance bill 2025, they incorporated so that it will become full-fledged. Certain changes having significant impact are reflected in the provisions of ITV, and most of changes appear to be unintended drafting. Actually, we found while I was examining the bill, I found also many cases the reference sections etc. Is not correct, and this type of mistake is very difficult to identify. But the trade associations, institutes, so different institutes, including our institutes also, we pointed out to some of the sections where uh, the changes, the incorporation made, but it's not a correct incorporation. That also it will happen when a new bill will come. Definitely, it will be refined in the process, so that we should not take as a negative for the purpose. Now the coming to the changes. So first change I started with the definition. What happens? We found in the ITA the opening the definition clause is there. Clause 2 or section 2 is there. But subsequently, the many chapters separate definition also there. Now they brought all the definition into section 2 of the ITA, of the section 2 and the clause 2 of the ITP. So once the bill passes, then it will become section 2 also. So that they have kept it. The residential status, clause 6 particularly, actually the slightly some changes made, but it has the effect of having the taxability, increase in taxability. A small change they made. So what is that change? You might have seen the present section 6 provides that one of the conditions stay in India. And if you are a resident, a non-resident concept is there, and stay in India is very important. And particularly the criteria 180 days and subsequently the amendment made in the 120 days in certain circumstances. And what happens? In case of any assessee, any person who is going outside India, leaving India, we can say the word leaving India, for the purpose of employment outside India, the word was there. For the purpose of employment, they made it there for the employment outside India. Purpose means purpose you are going. So in place of 180 days, your criteria has been kept 60 days. So if you are in 60 days, 180 days more outside India, you will be treated as non-resident. Here, 80 has been replaced with 60 days. So the one of the conditions that the purpose of employment. So you are going the purpose of employment, but you are not going for employment. You are not employed, but still you will ensure the that status, residential status, and thereby what happens, since you become a resident, income outside India also taxable in India. If you have become non-resident, income outside India is not taxable in India. So that's why the for the purpose of employment has been replaced with the for the employment outside India. Employment outside is very focused than the purpose of employment. Another is reasonable attribute of actually this is the government in the process tried to increase the make a lot of amendments, particularly section 6 and section 9. After the incidents of a Vodafone, you might have seen Vodafone, the share transfer case, the transfer, the purchase and sale taken place outside India, but the company situated in India, share in India. So when the tax was demanded, the section 9 could not have the provision to taxability on the capital gain of any asset in India, but the transfer both outside India. So that's why the major amendment taken place. So even if the buyer, the seller outside India, but the asset is in India. Asset means share in this case share in India, but still it will be treated as a transfer and capital gain will arise. Section 9 has been amended. Similarly, government tried to amend many of the sections, and particularly income from business connection in India. If any non-resident or anybody from outside India but having business connection in India, then in that case, the income will be taxable in India. And business connection in India, when because a specific account is not prepared, it was prepared along with the consolidated financial statement. Sometimes it was found difficulty. That's why they told that the assessee who if all the operations are not undertaken in India, suppose an assessee outside India, its operation is not taken place in India, some of the operation is taken place in India, and some of the operation taken outside India. So only the operation in India is to be taxable, but they are preparing a consolidated statement or profit and loss. So in that case, a reasonable attribute, reasonable amount will be taken, which is attributable to operation in India. So reasonable is a very word where the scope will be more, and what is reasonable for you? You can decide something reasonable, which I can also tell that this is reasonable for me. So that's instead of that, now in the ITB 2025, they made it that the word reasonable attribute, they have slightly changed it. So the term business connection in India shall include business carried out in India. It now provides that only so much of the income, not the word, so much of income that is attributable, not reasonable attributable. Reasonable attributable is approximation. Attributable is very accurate. So that's why the only the income which is attributable to India is it going treated as a business income or business income, business connection in India and taxable. So that means it will increase the broad base of the assessee. And the section 10 contains a lot of exemptions, and there are a lot of subsections also. Now what happens? They made it table. First is the exemption under ITB 25. They made schedule 2. 16 rows are there. System income, 16 incomes which are related to the agriculture income is exempted. Similarly, schedule 39 row, 39 items are there. Certain persons eligible for exemption on certain incomes such as farm and HUF. So these exemptions are only available to farm and HUF. Similarly, schedule 4, 14 row, exemption for non-residents. Schedule 5, 8 rows, exemption to business trust, sovereign wealth fund. Schedule 6 is 12 rows, income to IFC units. Schedule 7, 48 rows, persons exempted from tax. So these type, that means schedule 2, 3, 4, 5, 6, 7 grouped and a tabular form given thereby the which income or which receipts are exempted has been categorically mentioned. Just example, you see any regiment fund or non-public fund established by the armed forces of the Union, there is exemption. Earlier it was covered under section 1010 some subsections. Now what happens? A tabular form has been given. This is the eligible person. This is the exemption condition. So such fund is for the welfare of the past and present members, then armed members, then it will be exempted. So by making the tabular form, not only the words has been reduced, it will become very attractive. And at a glance, you can see categories. You can see. Honestly, I'm telling. Sometimes when we are referring section 10, we are just searching. Even if you are very expert in the income tax, but you are going for the search. But here it is not required. Straight away, if we the exemption I am searching, which is non-resident, I will go to the schedule 4. If it is related to the person's general, then I will go to schedule 7. So it is easy to understand. Then coming to the computation of income, and first we will take up the salary. Already I clarified you. Major changes has not been taken place. Very cosmetic changes has been taken place. Wherever they found that redundant provisions, they also taken into consideration. First, the threshold limit, the 50,000, there's a specified employee. One of the provisions you might have seen under the salary provision, certain benefits which is given in the kind. Particularly, I'm talking about to gardener, your sweeper or servant, those who are provided by your employer, which is a taxable perquisite, and valuation has to be made. And there it is given that in whose hand it will be taxable. Now it will be taxable in the hands of a specified person. Who is the specified person? Then the employee specified person. The amount is 50,000 rupees. So that means anybody can be the specified person because everybody's income is more than 50,000. So that's why it has no meaning at all. So now government, what happens? They made it provision that specified person will be notified by the CBDT. So once the rule has been formed, for the purpose of taxability of a gardener, for the purpose of the taxability of the sweeper, etc., what I told, certain amount of perquisite, one can the CBDT will fix it later. They will tell those who are getting salary more than 10,000 rupees, 10 lakhs rupees can be treated as a specified person. So like this, the amendment has been taken place. There is a medical treatment outside India is also exempted, and there is a condition that there is a threshold limit of 2 lakhs. So particularly if anybody is going outside India, employee is providing money. Employee is providing money for the treatment outside India as well as travel outside India. So travel purpose exemption, there is a threshold limit was 2 lakhs. So thereby what happens, the travel outside India is costly, but it is not you will get it, and again it will be taxable in the hand. You first mentally you are harassed because somebody is falling sick and you are taken to the foreign treatment. And the second, the medical treatment is exempted, but the travel is more costly. But in that case, exemption is available only if the threshold limit is 2 lakhs. So that has been removed. No threshold limit has been kept. And another point was there to get the medical expenses exemption. If it is a government hospital, so it is exempted. If it is other than government hospital, means private hospital, then you have to bring a certificate that that hospital has been recognized by the Commission of Income Tax exemption. So that means in the process, if somebody is getting treatment in private hospital, so that bill your employer is paying, so you are not getting exemption. So now what happens? You are bringing a certificate that this hospital already recognized by the Commission of Income Tax exemption. So thereby on that basis, your employer payment towards meeting the expenditure is also exempted. But now question what happens, that certificate is not required. So whether it is the government or it is other than government, recognized or unrecognized does not matter. So the medical bill will be getting exempted. This is actually redundant provision, we can say. And a house property used for business or profession, which was there, that is a may occupy. Now they made it occupied. You just see what is the difference. I am an assessee. I have a house. I may occupy this house for my business. So any house will be occupied for the business, then it will not be taken for computation of income. You might have seen, as per the provisions, so 2 houses you can keep. One house one can get the exemption. Earlier it was 1 house, now it is 2 houses. Let I have 4 houses in Bhubaneswar. 2 house, all the houses I kept vacant, or I am occupying. So actually 2 houses cannot be, you are not going to get exemption. It will be treated as deemed let out, and accordingly tax has to be computed. But if you are occupying any house for the business purpose, then it is not taken for the house property income computation. You may occupy for the business purpose, but may what is occupied. So that means if during the tax period I occupied my house for the business purpose, then I will get the exemption. Means deemed computation of income will not be required. So this is they made it because may occupy means even if not occupied. So but you can go for the getting the benefit for that. So that's why they made it occupied. Business income, they have expanded. Friends, just I'm giving one overview. Profits and gains from business, it contains in the section 28. 28 is section 28 contains different receipts which can be treated as business income. And section 30 to 37 contains different types of expenditure. Number of subsections are there. And these 30 to 37 again subject to certain restrictions. 40, 43B and 40, you might have 43B, 40 have a lot of subsections. Even if it is covered under 30 to 37, but the benefit is not available if you are not fulfilling the condition of 40 to 40. Let me take one example, cash payment exceeding 10,000. So 48.3. It is the expenditure. So it is covering under 30 to 37. But it will not treat it as a business expenditure for the purpose of computation. It will add it back to your profit. The reason is you made the payment more than 10,000 in cash. And not exception, those are the exceptions are available that is not in your favor. Similarly, I'm the non-deduction of tax at source, 30% of the amount will be taken as disallowed. Similarly, purchasing of a certain goods from your relatives, which in the opinion of assessing office is more than the market price. 43B is having restriction, payment, non-payment of taxes by due date of filing return, non-payment of provident fund, gratuity. Like this, many sections are there, there's a restriction. Now what happens? Section 28 is having the number of list, income from business, income from profession, carbon, lot of items are there. So one of the very important point is any export incentive you got, it is nothing but a business income. But that should be under the Customs Act and trade policy. But now it talks about that any other export incentive. So the different provisions of the Act, Customs Act, new trade policy allowed sometimes for certain benefits. So that benefits, if you are receiving, you can show as income in the computation of business income. Now they expanded that not only restricted to the Customs Act, not only restricted to the foreign trade policy, not only restricted to the specified policy, but any other incentive you are receiving and it is appeared in your profit and loss account, that is also nothing but a business income, and you have to take into computation of taxation. Market to market loss, particularly notional losses of the securities, which is ICDS. Actually, they wanted to make it par with the ICDS. You might have seen the Income Tax Act, while computing the income, particular business income has to comply with the income computed disclosure standards, which has been available. And that's why the in case of a loss of securities, whether it treated as business expense or not, it depends upon the ICDS provisions. Now they applied in the Act that mark to market loss in the valuation of end of the year also will be treated as a business expenditure. And previously we have 31 two sections: repair maintenance of building, repair maintenance of plant and machinery and furniture. They combined it. So repair, maintenance, insurance of a business asset. So that will be treated as a allowable under one section. They made it clause 28. Clause 28 is subsequently become the section. Deduction of depreciation. Actually, you might have depreciation is an area which the one is getting substantial benefit. At the same time, the computation made by the assessee is number of ways these are the suffered from the demerits because of the old provision. Provision is very elaborate. The explanations are there. So actually, if you see, the depreciation provision is 63 years old. 6 clauses, sub clauses, subsections are there. 9 provisions are there. 6 explanations are there. And what happens in the ITB? They made it, they reduced it by 40%. So they made a very concise, so one can easily understand. Actually, that became voluminous because introduction of many of the provisions from time to time. So that's why they made they tried to reduce it so that it will be more attractive. And in addition to that, certain changes also made. Actual cost of asset to be reduced by GST, on which the input tax credit is taken. So you have taken input tax credit means you cannot part of the cost of depreciation. This was not in the IT actually, but as per the principle, if I have taken depreciation, so in the books of accounts, so I am definitely not capitalizing it. It is once taken, it is not going to be capitalized. But that was not in the provision IT. So now they made it very clear. Depreciation on intangible asset, deleted acquisition data. Actually, that was a restriction. Just like your if you acquired any asset, intangible asset, intangible software, etc. Earlier acquired on or after 1998, what is there? So prior to that, you have taken, you are not eligible for depreciation. Now they have omitted it. There is no restriction. Anytime you acquire it, it's continuing means you have to going for getting the depreciation. Proportion depreciation, that concept has brought out. If any asset, many assets are there, you are using in the business 100%. So 100% depreciation you have to take. Many assets are there, you are using personally and you are also using for the business. So proportion depreciation you have to take. Let I have a motor car, I am using proportionately. Anyhow, it is very difficult. On particular, I am talking about to individual HUF to know whether the percentage, whether using personally or using for the official purpose. But the provision talks about that if any business asset is used for the business and as well as the same time it is used for the personal, so proportion depreciation can be allowed to the assessee. Then ITV introduced a new soft clause allowing fair and proportional deduction when the premises, plant and machinery, furnitures are partially used for business or professional purpose. Assessing officer is empowered to determine the appropriate proportionate. Again, I'm talking, this is a disputed area. So when the assessing officer has been powered to proportionately calculate, so definitely this may not be acceptable to you. So anyhow, but this provision is there. Deduction for bad debt and provision for bad debt, doubtful debts, particularly this provision. One section, subsequently it become part of the section, and there is some provision has been bifurcated. Some for the bank, financial institution, separate provision. Other than bank, the bad debt provision is there. And as per the ITA, the provision is provision for bad debt. If you made in the accounts, it is not a business expenditure. Bad debt is a business expenditure if it is written up in the books of accounts. And if he bad and doubtful debt you are making provision, it is not a business expenditure. And there is also similar provisions are there. If you have a written bad debt, you have if any amount you have written up as bad debt in the profit and loss account. Bad debt written up means it will be reduced from the debtor, not shown as debtor 100 less bad debt. No, less provision for bad debt you can write. So that's why it is not allowed. If it is written off, then instead of 100 debtor can be shown as a reduced value in the financial statement. So in that case, only the written off means wherever in the books of accounts it is reduced from the debtor and the net of the debtor is showing in the financial statement. In that case, that expenditure is allowed as a business expenditure. And subsequently, if you receive it, let you have taken bad debt as a business expenditure because already it is written up in the books of accounts and it is allowed by the income tax authority. But after 5 years, let you recover it. So as per the provision, you will show it as a deemed income, deemed business income, particularly under section 41 ITA. And the similar provision it is retained in the ITB, but it has the drafting has been reduced and it has been concise. So thereby one can easily understand instead of many sub provisions, sub clauses, etc. Taxes paid on income, some ambiguity also there in the ITA. Already I was telling that section 40 of the ITA contains a lot of provisions which are not allowed as business expenditure. Income tax is not allowed as business expenditure. Okay, but the issue was there. It is written that income is not allowed. Income tax is not allowed as a business expenditure. Interest on income tax is also not allowed as a business expenditure. Money borrowed for payment of income tax also not treated as interest is not treated as business expenditure. This provision is there under section 40, having a subsection. So where that the restriction is there, but nowhere written that which income tax, whether it is profit or gains of business income tax or any other income tax. So actually, it was interpreted that any tax which is levied on the profits or gains of any business or profession or is assessed basis such profits or gains is not allowed as deduction under business profits and gains from business profession. So that's why it made it very clear. So that's why income tax paid on income shall not be allowed as expenses in the computing business. So here in the ITB, it is not restricted to income tax on the business profit. It is restricted to income tax on any. I have a income tax on my other income. So people claiming it also treated as business expense under the Income Tax Act, under the provisions of Section 40. So that's why they made it very clear that taxes paid on income shall not be allowed as expenses in computing profits and gains from business expense. Not that only profit and gains from business profits. So they made it very broad. And the second is you might have seen the presumptive taxations are there. And what is presumptive tax? Few examples I'm giving. 40 for ADA, you are the professional and you have two options. You can compute your business income, or sorry, professional income, and take the expenditure and get it audited. And the net profit, what net taxable income, whatever will come, that you can go for the payment order. But instead of that, 50% of your receipts can be treated as income on which you pay tax. No expenses will be allowed. Similarly, 44 AD contains traders, civil contractors, small traders. So many lists are there where a certain percentage will be treated as income. Particularly, I'm talking in case of trader and civil contractors, where if the amount is received through the banking channel, then 6% of the receipts will be treated as income. If it is a non-banking channel, then it is 8% will be treated as receipts, which can be treated as in taxable income. No deduction is permissible. So on that income, you go for the payment of tax. So what happens? Similarly, 44 AE, these are the flying of trucks, etc. Certain conditions are there, not more than 10 trucks like this. A certain amount is treated as a taxable income instead of a computation of a profit and loss account, etc. So now what happens? They made it a table. So they made it a very simple language with tables they made. So easily one can understand what are the sections are available for the purpose of getting the presenting income. New section, revenue recognition, service contract, and inventory valuation was introduced. So inventory valuation is a core area. Certain provisions are there. Government can go for the engaging a cost accounting for the inventory valuation, inventory audit. So that's why the new section, revenue recognition, service contract revenue recognition was little bit difficult. Civil contract revenue recognition was there. Contract revenue recognition, ICDS provisions are there. So they made it a revenue recognition for service contracts and inventory valuation. Information technology company secretary had been included under section 44 to maintain books of accounts. Section 44 contains that you can maintain a books of accounts if your income is exceeding certain limit. But the categorically it was not mentioned information technology and company secretary by way of a CBT notification they are covering. Now it is directly included in the income tax bill, just like your chartered accountant, cost accountant, they are the professionals. Similarly, information technology and company secretary also treated as professional and directly included. Presumptive taxes on non-resident providing services for electronics manufacturing facility. That is, this was the amendment made in the 2025 Act, also incorporated in the finance bill. Capital gain, many of the transfer provisions has been removed. Hence, section 45 to section 54 contains provisions regarding computation of capital gain, short-term capital gain, long-term capital gain. But for the purpose of capital gain, the very important point is there must be a capital asset. Capital asset must have been transferred during the previous year. So what is transfer has been defined under section 247 of the Income Tax Act. And in that case, a few of the provisions which are not treated earlier as transfer, now it has been omitted. So that means it will be treated as transfer. What is that? The stock exchange members. Suppose I am a stock exchange member. I am transferring my stock exchange card to somebody getting the money. So as per the old provision, means ITA, that transfer is not treated as transfer. Generally, what happens? I am a member of Bombay Stock Exchange. I purchase a membership card late by paying 10 lakhs. Today, I do not want to continue as a member, but a new member is restricted. So I am transferring my membership in favor of X in lieu of 1 crore as the consideration. So now what happens? In that case, the exemption was available. Now this exemption is not available. Similarly, Sikh industry, if it transfers any land building, that was not treated as a transfer for the purpose of computation capital gain. Now it will be treated as a transfer, capital gain will be computed. The reason is stock exchange has improved like anything. Many people are competing to become the member. There is no such thing because government wanted that whenever people are not interested to become the member. So that's why this provision was there. Now everybody wanted to be a member by paying the money. So that's why these transfer provisions were taken out for the purpose. For the purpose it is taken out so that I'm in one webinar. I will talk to you after some time. So these are the transfers has been omitted. So thereby this transfer is subject to the capital gain, and a gift received by an individual from linear antecedent and descendant. These are exemptions are available. You might have seen income from other sources. So relative friends, if any money you received or any property received to certain extent, exemptions are available. But now what happens? It has limited to the paternal or maternal. So suppose I will get some gift from the any of the relatives. So that definition earlier under the IT Act was very broad. Now it is only restricted to any persons from my maternal or paternal. That only will be taken for the exemption. And a new clause investment linked expenditures. Actually, the number of investment linked expenditures are there under section 35 particularly, where the assessee while computing the business income, they are getting 100% deduction. Actually, capital expenditure is not treated as a in the accounts. So we capitalize it, depreciation has been taken. But under income tax, certain incentive linked claims are there, benefits are there, wherein 100% deduction is granted on the capital expenditure incurred with respect to specified business undertaken by the taxpayer. So if these assets have been sold, the sale proceeds are fully taxed as a business income. That was the provision was there. Now they return the provision like this, but there is no specific clawback provision to the tax subsequent sale. Just I am explaining you cold chain business, let you take cold storage, let you take. And similarly, certain, I think 14 items are, to my understanding, is available in the computation of business income, where if you invest the money and incur the capital expenditure going for adopting that business, so entire capital expenditure treated as your business expenditure, and you continue with the business. But subsequently, suppose the asset you have sold it and getting the income. Suppose I use the asset 10 years before got the benefit, so thereby no further depreciation, but that asset today I am disposing having the income. As per the old provision, since you taken 100% tax benefit, so on sale it is treated as taxable income. So now what happens in the income tax bill, the first part remains same, 100% incentive linked the benefits are available, but there is no provision found that it is on sale, it is taxable. I think there is a omission. So government may introduce it subsequently. So in the drafting, there may be omission because it is very clear principle in computation of business income. If I have taken 100% deduction of any capital expenditure, and I'm selling subsequently the residual asset. So that is nothing but a dim income under section 41. So that's why this clause, I think, inadvertent omission may be there. These are the specified business deductions are available. Development, operation of infrastructure, set of cold chain facilities, building, operation of hotels, hospitals. So actually, this has been the benefit is available, but after filing certain forms, prescribed form, Income Tax Act having prescribed certain forms which will be certified by an accountant and to get the benefits. So this is section 35 AD benefit, what I was telling previously slide, same thing is here. To get that benefit of 100% capital expenditure on particular in respect of this business, you have to go for certification in a prescribed form, which contains number of tables by which the details will be given. But under Income Tax Act, the same capex provision is continuing as a deduction, but certification is not there. So I feel that these two sections may be the particular the first section is a omission. Second section, government may think to reduce the funds because the government intent is to as quick as the procedures to get the benefit should be reduced. And anomalies in allowances or specified expenses on actual payment. Actually, you might have seen in computing business income and omnibus provisions, 43B, I was just telling, 48.7 is related to the gratuity, 48.3 related to the cash payment. So these are few sessions are there. And the condition talks about that the expenditure is incurred by the assessee is a revenue nature and covered under section 32 to 37. But if certain condition they not satisfied, then it will be disallowed. That is actually the provision under the Income Tax Act. So relief otherwise allowable is absent, creating ambiguity. Otherwise allowable meaning is it must be allowed 30 to 37. But since you are not complied with this section 43B, 47 or 48.3, then it will be disallowed. Just I'm giving an example. Payment of a gratuity is allowable business expenditure covered under 13 to 37, 36. But the point here is if it is not paid in cash or is not paid to the trust, then it will be disallowed expenditure. So otherwise allowable word was there. Otherwise it is allowable, then it will be treated as reduction. So if the word is not there, I think these are maybe some drafting mistakes. Because if it's not by business expense, how it will be going for disallow under 43, 47, 43B and 43. 43B talks about the interest. Interest paid to financial institutions will be allowed as it is a interest is covered under section 36. It is allowable expenditure, but it will not be allowed if not paid by due date of filing return. So 2024-25, it will pay interest by October 2024, then it will be treated as a business. It would be treated as a business expenditure. So that is a restriction. Unless it covered under 30 to 37, then the 43B, 48.7, 48.3, 40 is having a lot of subsections, is not applicable. So this may be omission to my understanding. Similarly, a sum payable means a sum of for which the taxpayer has incurred liability in the tax year, even though such might not have been payable within that tax period. What is the meaning of payable? Payable means it already incurred, but you have not paid. So that's why it must be payable by 31st March, but paid subsequently by due date, then it will be allowable expenditure. So these type of words are missing, and which really create the ambiguity. Actually, we also, to my understanding, proposed certain changes to the department also. Then the question will come: set up carry forward of losses. Set up carry forward of loss of a demerged amalgamation company. Actually, there was a provision when a company will be demerged, amalgamated, then the loss of the vanishing company will be continued by the new company or the continuing company. So thereby the 8 years restriction is not there. You know, carry forward of a business loss, the restriction is 8 years. Speculative loss restriction is 4 years. After that, you cannot carry forward. But in case of amalgamation, demerger, the 8 years criteria was not there. Now they have restricted. So they made it 8 years. There should not be, but they reduced it. Transitional provisions has been taken out. 71 is transitional provision. That one, when the new act introduced the transitional provision, now it will also in the income tax bill 2025, there is a transitional provision also plays important role. It is also there. So transitional provisions, whatever the earlier act is continuing, so everything will be omitted. And the deeming provision 69B was actually 69B. 69 has been splitted. So one is unexplained investment one is unexpected wealth. Already I was telling you 68 is the cash credit, 69 is the unexplained investment. So that has been split into two parts: unexplained investment and unexplained wealth. So these are treated as undisclosed income, and in the computation, if undisclosed income is there, then the tax rate will be 78.5%. So they made a distinction: investment and wealth. Actually, if the word investment is there, that means you have undisclosed income, you invested, then it will be subject to tax. If you have not invested, keeping in the form of wealth, then it may not be. That's why they told, okay, you have undisclosed income, which is in the form of wealth, but that is also covered under the undisclosed income where the higher rate of tax is applicable. No change in the incidence of tax in the methodology of clubbing, because clubbing having a provision, many provisions are there. So that asset transfer without adequate consideration, transfer of income without transferring asset, joint individual property become the joint family property. So in that case, the clubbing of provisions are applicable. Minor income, similarly, income of the spouse, clubbing of income of the spouse. So these provisions, major changes has not been taken place. But one of the major changes taken place in case of spouse, the word certain wordings has been changed. Income could be attributable to the application of technical or professional knowledge, experience, and qualification, but it does not explicitly says that the spouse must possess such qualification. Actually, previously what happens, if any income has been transferred to the spouse, and the spouse is not having the qualification, technical qualification, in that case, that income will be clubbed in the hands of the transferor. And let I give you an example. X is an advocate, and Y is the spouse. Y is not having the LLB degree or any qualification for the tax practice that you take. Husband is an advocate in tax practice. So in that case, the department sometimes looks that whether the spouse is having a technical or professional knowledge or experience or qualification, so that whatever salary paid by the other spouse to the second spouse, let you take it, so that will not be clubbed. Otherwise, it will be clubbed. So now what happens? The new act, qualification is not there. It only talks about that if the spouse is having expertise, experience, knowledge, then in that case it will not be clubbed. So it's a good suggestion actually, but you will find in many cases this is a very high dispute area. You may not have the technical qualification, but you can also discharging the function of related tax returns, etc. So in case of spouse, let to take a department sometimes objected, but she's not having the qualification. So now that is specifically not mentioned. So that is there. Formula has been introduced to in certain cases. Actually, in that case, if asset is transferred without consideration or inadequate consideration, a formula has been adopted. So formula of the percentage basis, how to calculate it. So that has been provided. Already I told in the beginning, many cases formula has been provided. Formula, suppose I am talking about one of the example, a refund of excess income tax. A formula also has been provided. What is the amount of income tax, which date it was deposited, which date it was refunded, what is the percent of interest, the formula is there. So automatically it will be calculated, accordingly it will be paid. Section 80 TT8, 80 TTB was merged in one section. Previously it was senior citizen and others. Advance tax, there is no change at all. Policy changes is not there, same percentage remains, and no major changes has been taken place. Refund interest already I told you. Special rate tax remains same. So they have not touched in the IT bill 2025 MAT tax or AMT, carry forward of AMT, tax rate of 15, 20, 22%, 15%, 25%, which certain criteria 30%. Similarly, slab rates, because it will be only affected through the Finance Act every year, the slab rate will be changed. So no changes has been made. intercorporate dividend, certain modification has been made for the purpose. And tax audit provisions, again, they made it, the major changes has not been made, but in the ITB, they incorporated just 95% of the aggregate. You know that tax audit is applicable in case of RCC whose income is exceeding, receipts exceeding 2 crores, but in case of 10 crores, 95% of the total receipt must be other than cash. So payment must be in the business through the banking channel. So that they kept it. And but that is one technicality was there. So to whether in any case the tax audit is applicable exceeding 2 crores, but it is not applicable if we exceeding 10 crores, not exceeding 10 crores, which cases if we out of the out of the total turnover, 95% of the turnover is received through the banking channel. Only 5% turnover is received through the not only turnover, both receipts and payment. So 95% of the receipts or payments are through banking channel. So in that case, the threshold limit is 10 crores. If it is 5%, that means available for the cash. So it is whether related to only business receipts or the entire bank receipts. So that's why it has been clarified that to applicability of 10 crores. So all only the receipts related to the business will be taken into consideration, not the other receipts. Non-resident related presumptive taxation. There is no such major changes is there, but the setup and honorable depreciation, brought forward business loss, these are the restrictions which are there in the income tax bill. 80G of the Income Tax Act, certain changes has been made. It is not major changes. We will not discuss, keeping in view the time constraints. That you can, this slide I will share, you can go through it. Maintenance of books of account. One thing, now the maintenance of books of accounts, so in case of non-resident taxpayers, those are the going for presumptive taxes. So, present, just I wanted to tell you in the present context, let I am a professional, I can adopt for the presumptive taxation. So if I am adopting presumptive taxation, if my total receipts let 50 lakhs, let 40 lakhs, 20 lakhs, I will take the receipt, 50% of the receipt. Then no expenditure. So my taxable income can be taken as 20. But I have another option. So in that case, I can go for the tax audit. Even if my receipts is not exceeding the threshold limit of the tax audit, because specifically it is applicable to presumptive taxation. So in that case, I can take the expenditure, take the income, just like other assessing, compute. I can show the, instead of 20 lakhs, it can be 7 lakhs, it can be 12 lakhs, it can be 15 lakhs. So I can take as a taxable income and go for. But this was not available. Maintenance of books of accounts and getting this benefit was not available, particularly the non-residents. Now in that case, the non-residents can also offer lower income to the taxation by adopting or maintaining books of accounts and auditing the books of accounts as applicable to the resident assessee, those are availing the presumptive taxation. So they extended to the non-residents. Undisclosed virtual assets, particularly, they have declared that these are subject to the 78% tax, that is the undisclosed income. So if any assessee having the virtual assets, virtual digital assets, and a virtual digital asset has been defined, that is it includes money, bullion, jewelry, other valuables. It is presently categorically included the VDA with along with the jewelry, bullion, and other valuable asset. So in that case, if it is undisclosed, then the tax rate will be 78%. So actually it is 60% plus 25% plus 4%. Whatever the effective rate will become, that will be taken for the purpose. And a 25 bill includes taken into account the VDA. In the earlier it was covered money, bullion, jewelry, or other valuable asset. Now it includes the VDA also. So that means the scope has been expanded for the purpose. Computation of income, no policy change proposed, special rate provisions. New tax regime is also continuing. There is no change at all. Old tax, new tax regime is continuing. It is applicable to the both individual, to all individual taxpayers, domestic companies, cooperative societies, eligible taxpayers. Tables are provided to do away with multiple explanations. Return of income, only PAN is streamlined, so that is very important. Once you have the PAN, and the department can go for issue of the notice if you are not filing the return. You might have seen before filing the due date of return, you are getting some SMS. After completion of the due date, but there is a revision of the, say, filing of a revised return date is there, or the filing of a final return date is there. So in that case also you are getting message. The moment you are crossing the timeline, so you will be issued with a notice under section 142(2). So in that case, what will happen? 142(1), not 2, 142(1). Will get notice. So you have to respond it. If you will not respond, the department can go for the base judgment assessment. So by holding the PAN is not there. That's why they streamline the PAN. At the same time, they are monitoring the PAN. So all the concepts are kept in the new provisions also. Transaction tax, they made it in the line of long-term assets. Already I told you in the Finance Act 2023, transfer of property, land and building without indexation is 12.5%. So they extended to the long-term capital gain arising to non-residents other than financial institution from the transfer of unlisted shares in India. They have extended it. So 12.5% they made it. Another very important point is brought forward a long-term capital gain can be set up against short-term capital gain. It was not there, so they made it in the new provision. Major changes has been taken place in the trust actually. If you go in detail, the trust plays very important role. So 2.6 lakhs, 61 lakhs registered trusts are there, and they are non-profit organizations, we can say. And NPO, the concept was not NPO. Previously, it was hospitals, educational institutions, different non-profit organizations. So NGO, what we can say. But now the concept they made it as NPO. So there is no concept of hospital, no concept of education institute, universities to claim the benefit of exemption as a trust. So they all are treated as NPO. Second is all the provisions are applicable at section 11, 12, 12A, 12AA, 12AB. These are the 13 political parties. And these 11, 12, 12AA registration provisions are there, exemption provisions are there, which condition satisfied. In addition to section 115 BBC, BBI, 115 TD. So you see, the sections are created in different phases. So now what happens? A new chapter was introduced. So for the non-profit organization taxability, a separate chapter was introduced, and the chapter is 17. It is special provision for registered non-profit organization in the new bill. So in that new bill, just to see on the left hand side, it was the old provision, and right hand side you see, and all are in the one place: registration, income, commercial activities, compliances, violations, approval, donation, and for donations, interpretations. Everything kept in the one area. Friends, just I wanted to tell you that why government wanted to do that. If you see the Finance Act 2024, you will find 2.61 lakhs of trust are deploying around 11 lakhs crores of money and getting the exemption. So the computation of a non-profit organization particularly talks that 85% of the surplus, whatever is there, if you invest in the specified asset, then you will get the exemption. And that can also be, exemption is available, you can carry forward, and next year also you can do. So In that case, the government has no control of whether it is properly spent or not. But on that amount, suppose assuming that there is no exemption is there, so 10 point more than 10.6 what the reporting is made, it's 30% at least you take that much is taxable income is up. That tax can be collected by the government. So that's why government has given both first on the NGA exemptions. So that's why they made a fast all the provisions in one place, and that will be monitored properly. And the validity of the registration, small trust to take away from this type of restriction or the compliances. So they increase the trust which income receipts does not exceed exemption does not exceed 5 crores. So they can also go for registration only after 10 years. Actually, previously, once you register, you can continue for the entire period till you suggest. But now amendment has been made earlier. Then they made it that every trust will go for re-registration, and the registration will be valid for 5 years. So every 5 years they have to renew. But for small trust, they made it 10 years. And a small specified person, those who are making contributions, charitable trust has to be exempted. So that's why they increase the threshold. 50 lakhs was there. Now it is taken as 1 lakh. So anybody contributing to the trust and 1 lakh each year, a maximum 10 lakhs total multiple years. So in that case, there is no reporting is requirement is there. And income applies will be no longer be considered as violation because trust will be allowed time to rectify error before any penalties are imposed. Strict taxation on business trust. Taxation of NPO appears to be cash basis. So these are the amendments they made in the to have a more control. Corpus donation received by registered NPO remains exempt, but the reporting will be there. Who is making the contribution, that reporting continue. So these are the major changes has been taken place. And if NPO is selling asset and capital gain is there, that capital gain also subject to the exemption, provided they are spending 85% of the surplus in the specified assets or specified infrastructures. So NPO for carrying out any business activity is restricted unless it is required for such activity. So many of the NGOs are NPOs, non-profit organizations are carrying out commercial activity and taking the benefit as exemption. So that has to be examined and restriction provisions are there. Then you are, I think. Those actually many cases the registration is already over by 5 years. It was pending, so an opportunity is given. If anybody NPO the registration has not been granted or operative since 1st April 2021, the chance has been given, so they can make a regularized or registered under the IT Bill 2025. So that was there. Registration can be cancelled by the tax authorities in specified circumstances. Now the cancellation of a registration includes withdrawal also. So that provision. So the scope mostly they have expanded the scope of the NPO. Another very important area that is TDS TCS advance tax. Already I told, and major tax has been collected through the advance tax and self-assessment tax. So just I'm giving statistics last year. If you see 38% of the tax collection from the TDS. So government has no role to play. Advance tax 43%, 18% self-assessment and regular assessment. So 43%, 38% total. I think 73 plus 8, 81. 81% of the tax collected, but the government has no effort. So government always wanted to expand the TCS and TGS provision. Every year you find it. There is certain new provision has been included. So at present, if we go for total advance tax collected, corporate 7.56 crores and non-corporate 2.88 crores. Last year it was 2.39. Last year it was 6.73. There's an increase in the advance tax collection. 43 sections under the income tax continued with the TDS and TCS provisions, out of which 33 for the residents. 24 sections are common or non-resident residents. 18 sections are common to both. Sorry, 24 for the non-residents, 18 are common. And TCS is the 9 category of payments covered under TCS. E-filing return, there is an amendment facility was introduced, refund filing of TDS, TCS, discontinuance of issue of TDS certificate. That is very important. Physical certificate issue is not required. Allow TDS credit, TCS credit can be allowed, can be availed by others. I have a credit, I can also transfer to somebody that credit. That facility also introduced. In mapping with the third-party transactions was very streamlined. E-review of TDS credit, e-payment of taxes, carry forward of TDS credit to next year. That provision is there. Generally, I am maintaining my books of account on the cash system, and I have a tax deduction. Let I raise the bill. My client deducted tax on 31st March, but not payment made. Payment made today in the April. I am maintaining books of accounts under cash system last year, 24-25. Then what I have to do? I'll not take the income. So in that case, TDS I will carry forward. So that facility is there. Trace become the game changer. So these things are continuing in the new tax regime, but the changes is made. They made it a table. Actually, all the provisions of TDS and TCS has been streamlined with a tabular form. Common provisions has been kept in one place. So it will be very easy, become very easy for the reference. So this is the PAN status already I told you. This is the, you see 2021 subsequent data I could not get it regarding the self-assessment advanced tax, but still then you see what is the percentage. So out of 16 lakhs, I think 6.34 plus 7.09, 13.43, 13.43 is out of the advanced tax and TDS. Self-assessment tax again 1.14. Only the regular assessment is 60,000 crores and 1.17 lakhs is other receipts. Around 2 crores to take is because of the effort of the government. So government streamlined, and you will find after the introduction of IT Bill 2025, the portal also is going to be streamlined accordingly. Then your single table already I told you, dedicated clause comprehensively, all exclusions in one place, and but the nil rate TDS certificate they have discontinued, but actually that's the only lower the deduction is permissible, but nil rate is not permissible in the finance bill. That is there. Actually, that should be nil bill. Many of the cases, what happens, TDS is deducted exceeding threshold limit, but it is not taxable. So I cannot get a nil non-deduction certificate from the department as per the new bill. Only lower the deduction I can avail, but the nil deduction should be allowed. CBDT is empowered to issue the guidelines that is there. TDS on this is actually one point I am not going to tell you. I confused MSCT. Return form likely to be more comprehensive because of we are expecting that no requirement to file a power of attorney. Actually, this is a omission. Actually, in case of assessee, those are incapable of filing the return. In that case, somebody can file on his behalf. So that's a power of attorney. So now there is no requirement of power of attorney. No provision to file updated return subsequent year where taxpayer filed updated return of the earlier tax year and such updated return in reduction of loss. This is the provision actually exists now, but that is exist only for 2 years. One can go for filing the updated return where there is an increase in income, increase in tax. If there is decrease in income or increase in loss, then they are not allowed. But other cases they are allowed to file, but within 2 years, so that they can avoid the penal interest on disclosed high rate of tax. But now that has been increased to 4 years. So it was proposed in the budget 2025, and same thing also incorporated in the IT Bill 2025. Valuation officer now can amend valuation report. This was not earlier. And ITB 2025 mandates dispute resolution panel has to pass a reasoned order. So that is that provision they made. Time limit to pass appeal effect order in cases authorized than by making a fresh assessment is increased from 3 months to 6 months, and 6 months to period can be further extended to 9 months. Actually, as I was telling you in the beginning, one of the most neglected area what we found, particularly many cases, the appeal could not be disposed for the long period. And you cannot imagine, to my understanding, even my experience, I'm talking, many of the tribunals are not functioning fully because the cases are not there. Actually, the moment you file the appeal before the tribunal, many tribunals immediately taking up. The reason is a huge amount of appeals are pending before the commission appeal, and they could not in a position. Many clients I have seen 2 times written submission we have given, but the appeals are not being disposed of, and it is not working properly. A portal also to some extent to what we can expect like a return. So that is the area where the dispute is increasing. The dispute, I think recently perhaps the government has given a direction. Government or Supreme Court has given a direction where somewhere I read that the Commission of Appeal Department should take an active step to dispose of the appeal from the Commission level. I think some court, Supreme Court perhaps. Scope of a search and seizure option expanded, and friends, be careful, particularly I'm talking any information stored in the electric media computer system that can be also accessible during the search operations. So survey operation, the statement shall now be recorded under oath. So oath recording definitely at legal consequences. Earlier in the search time, oath recording was not there in many cases. No objection certificate to be sought from the tax authorities in case of pending of assessment extended to transfer of a virtual digital assets. So that changes has been made. Dispute resolution panel transfer pricing certain provisions amendment has been taken place, and it was major changes has been taken place. And then the very important is so far whatever we discussed, a few changes has been made. Many changes, many area has been restructured. But another very important point is one thing is coming that up to 2024-25, there are return filing are there which will be made in the 25-26. Such seizure cases are pending, appeals are pending, assessments are pending, reassessments are pending. Many of the compliances basis, third-party databases or information from the CBIC, the notices have been issued, how to be complied with it. So that means the transition provision, what we can say, the 1961 Act is repealed, but even if repealed, but the operation of the Act related to the activities or the action taken will continue parallelly along with the Income Tax Bill 2025. So this is the very important point which you have to keep in mind. IT bill is proposed to applicable from 1st April 2026. Consequently, even if ITA 2000 is proposed to be repealed from the same date, with the transitional measures being provided to enable available of tax credits, carry forward of losses, unobserved depreciation, amortization of deferral of expenses across various years, and similar the tax compliances, everything will continue, and continue is proposed to be provided to various rules, instructions, etc. The department can issue. Just like you might have seen now also the under Finance Act, service tax, certain notifications are also coming, certain circulars also clarification is coming, because huge number of service tax cases also pending before different authorities. So that has to be seen. So the one of the important point is the Income Tax Act. The bill is to reduce the ambiguity or the disputes. Friends, just I'm telling, you might have seen from your past record, if you participate, whether you are going to participate in the amnesty scheme or dispute resolution scheme or not to participate. Our experience is those who are complying the law, they have been penalized. Those are not complying the law, taking the advantages of the very simple way. I will tell one case. Amnesty scheme under indirect tax has come, equal applicable to direct tax. So if you paid the taxes and taxes before the due date, if the your demand has been raised under section 73, then the interest and penalty waiver will be there under 120(a). One of my clients, small client, just I'm giving an example. Tax has been paid, 50% of interest has been paid. Now the amnesty scheme has come, so he is going to avail 50%. So he's thinking, why I paid 50%? I could have waited, but never you expected the amnesty scheme. So definitely you penalize. It is happening in all the cases. So it is a decision whether to go for not go for. But if you go to the history, 1951, there is a voluntary disclosure scheme, TAGI scheme, was introduced. Government wanted to resolve the dispute, so collected revenue also to substantially. 1965, block voluntary disclosure scheme and 60/40 scheme. Similarly, 75, implementation of 1975 voluntary disclosure scheme, but it was a failure scheme. 85, disclosure of wealth scheme. 97, voluntary disclosure of income scheme. So where the around 33,000 crores of tax has been collected. 2016 income disclosure declaration scheme. Sabka Vishwas scheme 2019 and Vivada Se Vishwas scheme 2020. Then Vivada Se Vishwas scheme 2024. These are the schemes already introduced. And this is the history of 2020, where the 3.4 lakhs of appeals are pending with the Commission of Appeal, 92,000 at Tribunal, 43,000 was High Court, 66,000 was Supreme Court. So thereby the scheme have the income received disputed tax of 98,000 crores and 53,000 crores has been received from different CP issue, etc. So to substantial certain money has been collected. These are the history you can see. So now question is, to what extent we are expecting that the income tax bill 2025 will be reducing the litigation. Again, I'm talking, unless the department, we found practically in many cases, the demand has been raised because the department officers may not have the sufficient time. Very hurriedly they issue the orders. So cause notices has been delayed, reply has been kept pending. Last moment it was issued, it was disputed. The honesty taxpayer will move up to the level of tribunal or even also High Court to get the justice. So dispute is not going to reduce. I have shown you that 15 point some lakhs crores of the amount could not be collected because of the dispute. 15 point around 16 lakhs crores could not be collected even if no dispute. So 31 lakhs crores around is pending. In the beginning of some slides I was presenting you. So where this is the statistic declared by the government last year. Last year, this is recent year, only in the month of April, sorry, month of February, perhaps somewhere I extracted it. So these are the things we have to see. And the very important last one before going for the discussion is what is our role as a CMA. And friends, I am not going to dispute the definition of accountant because you might have seen the institute on the tax force committee by which and certain inputs has been taken. Government is going to present perhaps on 16th. Representation has been given. President or other members have already visited that we are taking. So you know that this may be a different reasons why the accountant we could not be included, but we have every right to include with the we are competent not only the course curriculum, but also equally our members are occupied different places. I'll not going to discuss on that. But one thing I will tell that even if we are not accountants, the major point of a role or we can have the practice also as an authorized representative. But one thing is there, the authorized representative definition is given 1, 2, 3, 4. You will see 4 is the accountant, 5 is the any person who has passed the accountancy examination. So under that category we are coming. So why you should not be included a cost accountant? So that is the one concept. But in addition to that, we have a number of roles to play. Even if we are not accountant, many of our members are practicing as as a consultant, as a tax advisors. Legal professional advice you can provide. Professional advice, there is no restriction at all also, and professional opinion you can give also, memo also you can give on certain issues, and tax planning, alternate situations, computation of taxable income, availing different benefits, accounting of different expenses to the benefit or not, e-proceedings on behalf of the taxpayer, filing of returns, review of notices, drafting, finalization, replies, faceless assessment, faceless appeal proceeding, up to tribunal you can go for appearance, review of assessment orders, filing of appeals, and a review of a first appellated order, etc. So these are the area, particularly I'm talking about legal advice, legal opinion, alternative situation, and advice to the client to adopt that. Suppose I'm giving one example. In the beginning slide, I was showing the income tax rate has come down from 30%, 28%, 22%, 15% with certain criteria. But while you are going for 15%, certain benefits you have to forgo. So in that case, situation, whether you are going to adopt 15% or not, how to do it. So it can be exercised by a cost and management accountant who can also make a study of the prediction of the incomes, expenditures, taxability, and calculate alternative situation, find out which one is benefit by foregoing the benefit, adopting 15% beneficial or paying 30%, taking all the benefits beneficial. So we found many of the cases, the first one is beneficial, forgo the benefits, exemptions, deductions, but to pay 15%, that may be beneficial. So these calculations, no doubt required extensive experience, and your role is very important. And I was presenting a paper, as I remember, the digitization in income tax, digitization in taxation in the Eastern India Regional Council, particularly some days back. So where when I was making a presentation, people are very much anxious about the why the accountant definition we have not been included. This was the issue. And while I was answering very clearly, I told that the first part I cannot answer to his question, but other things when I explained, you told that it is a prestige. So we should be accountant, not the money. Maybe, but at the same time, when we are going for the professional practice, consideration also plays very important role. So my view is, in starting from our syllabus in the intermediate and final, we have indirect tax, direct tax well covered, and many of the members are in practice. So we should also look that these areas we can explore, create a confidence among the recipient of services, trade associations, and do the practice. That is a very good area in addition to other area which is available. Hence, keeping in time frame, and just I concluded it. And these are the overviews I presented. You can see it. Reading from section A to Z overnight is very difficult. Many changes may be escaped, not covered, but many I tried to cover it for the purpose of your understanding. Thank you very much for having a patient hearing. So before conclusion, I think if anybody from institute is there, so 293 attendance is there in this. So I am very much thankful to all of you for your patient hearing. And I think any question just I will take off. If any chart is there, just I wanted to take off. I think no chart is there. So nobody raised the question. Question answer just 1 minute. Any question answer just I will go for. It is uploading. Please wait. I think no questions are there. It is only limited to good afternoon. Some PPT somebody has written Chetan Gandhi. I think institute perhaps is going to upload. So you can get it. If you are not there, I am just giving my mail. Simply remind me. I will submit it. Wait for 2-3 days. If they will not upload, I think they are going to upload. Mr. Gandhi, just I'm giving my email ID. You can go for. We are looking for the overview of the new income tax bill, but you are giving the statistics on the income tax. Friends, anonymous, somebody has written. You see what happens when I started for giving the highlight of the income tax bill 2025. At the same time, statistics also required to make a comparison with the income tax bill 2025. So that's why it has been given. So if anything you do not like, you can ignore it. Whatever you like, you can accept it. That is up to you. But when the presentation we start from the beginning to have a lot of idea, then we can go for. It will be highly appreciated if I think the time at what time you have written 3:41. 3:41 is very premature time. If a gentleman is there, just you note it. It's a very premature time. The statistics which you have given definitely valuable to others. Not required to advise. Chat option working or not, sir. Network disconnection now destroyed.
Sir, we have a question
Yes,
like
yes,
after an appeal, a cost accountant can go to ITAT.
yes. Actually, as a cost accountant, you can go up to income tax appellated tribunal. You can appear as a authorized representative. But the only thing is there, as I was talking to you as an authorized representative, the qualification written anybody pass the accounting examination which is prescribed. So that's why the department approval sometimes people are taking. So that's why in the new bill it should be very clear, just like a chartered accountant, cost accountant, company secretary. So no, only that it may be applicable to other category of professionals. Those are passing the accountancy examination. Not they should that should not be kept for the cost accountants, because we are all already very much aware everybody that we have the accounting experience. But we can have many of the friends are appearing before the tribunal also. There is no issue at all. Just like your indirect actions, it should be direct. It should be written. Cost accountant, company secretary, it should be written. Can appear up to tribunal. It is not there in the act. That should be.
Sir, no other questions in the chat.
Just I'm going through. I think some person was
Some
very much.
network and other issues are there, but there is one question like, is there a change in clubbing in the provisions of income tax bill?
No changes is there except actually you see what happens. They made it very concise. Second is the clubbing. They made particularly a formula has been adopted. Clubbing of income. Third is in case of spouse, certain changes has been made, as I already explained to you. Professional qualification criteria, what earlier was there, is not required. That changes has been taken place. Somebody has asked the gift received during the occasion of marriage exempted. Yes, it is exempted. Relatives, only relatives. Nisim Liberty.
Sir, any
Nicely
threshold limit
explained.
on amount?
Which one? Clubbing?
No, for this marriage gifts.
Marriage gift is not there. It is talks about the limit is no limit is applicable for the relatives. Anyhow, I am very happy that some people are appreciated, except one gentleman who has written statistics is not required for him.
Sir, everybody have their different views. We
And
appreciate that
that's
the participants have, had made it an interactive
highly
session, and
thankful. Debasis Gangopadhyay. Thank you, Mr. Gangopadhyay. I kept the information structurally to have some knowledge. People may not have all the information. It is a fact. If anybody is doing tax audit, most of the cases they can go for the consultant. Somebody has written, is it rightly written? No doubt about it.
yes, sir.
After the appeal, a cost accountant can go till the IT. Yes, you can go
You
up to
just replied to
IT.
this.
Yes, yes. Just will you see anybody I left. Is there any change in the clubbing? Okay. If you are already established or person retired from service like you, may be approached for tax advice, but not from the direct person, out from the institute to practice. Industry may not be known then. You see what happens? I am telling, after my retirement, I am doing a tax practice. People should know about you, whether you approaching what actually people have the apprehension that if you have not recognized in the act, people may not approach us. But regarding the tax advice, regarding the tax opinion, regarding the other alternative situation issues authorized representative, I think depends upon the your expertise and people knowing about you. So I think in that case, recognition is not required at all in the act itself. Because if you are authorized representative, you can also give it. How to exposure to tax audit as other professional body. It is a you see what happens. One thing I will tell. The tax audit report is prepared by the CMAs. Many of the cost and management accountants are in the service. And at practical, I am talking, I was also in industry for 38 years. Who prepared the tax audit report? The auditor is not prepared the tax audit report. The employee concerned, the executive who is looking after the tax department work, he is preparing, giving to the tax auditor. Tax auditor is verifying, cross-examining. That is but the preparation is done by the cost and management accountant. Because we have a majority in the service sector. Actually, Mr. Somnath, gentleman, sir, you have given lot of amendments on the IT Act or the GST are good or not. What is your view? You see what happens? The provisions are good, but the implementation, the persons those are implementing, taking the compliance, sometimes it is misutilized by them. Take the example in case of GST. The provisions are very good. But if the provisions are good, but if we keep in mind to revenue collection, demand, initial issue the so cause notice, confirm the demand, not accepting the decision of the Supreme Court, then what will happen? You have to run up to the tribunal to get the justice. So question here is provisions are good provisions, but implementation stage or the compliance stage, it may be misutilized. Not all cases. There are a lot of department officers are there. Those are giving justice. In few cases, they are not giving justice because they may be interpreting it in different way. So we should face that. It is everywhere. It is there. If you can share the procedure to appear in the IT, so kindly talk to me directly. Anupam Pramanik. Sir, kindly you talk to me directly. I'm giving my number so we can discuss. I will tell how to go forward for the ITT. That I will tell you. 94371900. Now it is a faceless appeal. Tribunal, you can also appear in the video conferencing in addition to physical also. The e-filing system is also. and it will not be that difficult. It is very easy to appeal before the affiliated authority and tribunal also. I'm giving my two numbers. Just you see 933871543. Priyanka ji, just I will give the slide. You can also upload it. People can also go for see it. Okay, thank you very much.
Thank you for the. So we are ending the session.
Yes, yes, we are ending the session.
Thank you, sir.
I have given my mobile number. Yes,
Okay, sir.
Mr. I think Mr. Padmanik has just 1 second. I am giving 933871543. Okay. Okay, thank you very much.
Thank you
Thank you
for
very
your
much,
time,
sir.
sir. Thank you for your
If,
time, sir.
if anybody suppose has any issue, can talk to me directly. We can interact with each other also. Whatever possible, I can also make you update. Thank you very much.
Thank you, sir.